Welcome to IFRS Essentials. Today, we tackle one of the most critical and time-sensitive standards, International Accounting Standard 10, events after the reporting period. This standard determines how we treat major events that happen after the books are theoretically closed but before they are officially published. The events after the reporting period are those, favorable or unfavorable, that occur between the financial year end, the reporting date, and the moment the financial statements are authorized for issue. This final window of time is crucial because events during this period can drastically impact the truth and fairness of your financial report. IAS 10 splits these events into two distinct categories, each requiring a different treatment: adjusting events and non-adjusting events. The distinction hinges on one key question: did the underlying condition exist at the balance sheet date? Let's start with adjusting events. These events provide evidence of conditions that existed at the end of the reporting period. They are simply clarifying facts that already existed. The required action is clear: you must adjust the amounts recognized in the financial statements. Here are key examples. 1. Settlement of a court case. A lawsuit was pending at year-end. If it's settled after year-end, but before authorization for an amount different than estimated, you adjust the provision. The obligation existed at year-end. 2. Impairment of receivables. A customer goes bankrupt after year-end, but this event confirms that their financial deterioration had already begun before year-end. You adjust the allowance for expected credit losses. 3. Discovery of error or fraud. Finding a significant error that makes the year-end figures incorrect. Next, non-adjusting events. These events are indicative of conditions that arose after the reporting period. The condition that caused the change simply did not exist on the balance sheet date. The rule is the opposite: do not adjust the financial statements. The amounts remain as of the reporting date. However, if these events are material, meaning they could influence the economic decisions of users, you must disclose them in the notes. Examples include: 1. Destruction of a major plant by fire. If the fire occurs after year-end, the asset was intact at the reporting date, so no adjustment is made to the balance sheet. But the event is certainly material. 2. Major business combination or disposal. A significant acquisition announced after year-end. 3. Decline in market value of investments. If the decline is due to general economic conditions that arose after the reporting date. There is a critical special consideration: going concern. If management determines after the reporting period that they intend to liquidate the entity, or cease trading, or have no realistic alternative but to do so, then the basic assumption of the entity continuing in operation is invalid. In this case, the entity must not prepare its financial statements on a going concern basis, even if the intention arose after the year-end. This is one of the most significant adjustments required by IAS 10. To summarize, IAS 10 is the gatekeeper for post-year-end facts. You must clearly identify the event, determine the date the underlying condition arose, and apply the rules: adjust if the condition existed at year-end, or disclose if the condition arose after year-end and is material. And always evaluate the impact on the going concern assumption. This ensures that the financial statements provide the most current and relevant picture to all users. Thank you for joining us. If you found this useful, please like and subscribe for more insights into IFRS standards.